Amazon reported their third quarter earnings, and I think investors should be cautious here. Clearly, Wall Street disagrees, with the stock up around 7-8% today following their strong earnings. It's not surprising to see the stock up so much, partly because their results are so favorable. Last year, they were on track to burn around $20 billion in free cash flow. Now it's the exact opposite, where they're generating around $20 billion in annual free cash flow, give or take a bit, but a dramatic improvement in terms of costs, continued growth, showing that, hey, they're serious about profitability. And you can see this across the board, across all their different segments. Looking at North America, it swung from a sizable loss last year of a couple $100 million to a very sizable gain, $4.3 billion. Looking at international, that has been a continued laggard and cost center. Now it's closer to break even. Looking at their AWS segment, that continues to grow, shows nice profitability. So looking at it across the board, you see that they're heading in the right direction in terms of their profit motives, their profit focus. And there were several key initiatives that management called out on their call in this press release that sort of walks you through what they're focusing on. For example, they're clearly focusing on merchant reach, expanding their merchant reach with Buy with Prime feature, which allows Shopify merchants, so independent of the Amazon platform, to offer Amazon Prime benefits. So that's the seamless checkouts, fast free shipping, free returns on eligible orders, while completing transactions through Shopify's checkout using Amazon stored payment methods. So this is an example of Amazon saying, hey, let's get creative. Let's figure out how to leverage our fulfillment with businesses that aren't even on our platform. They can be independent companies. If you enjoy educational investment videos, you're watching Unrivaled Investing. My name is Daniel. Let's keep going into understanding the various different initiatives that Amazon is doing to win business, win customers, win merchants. If you enjoy these types of videos, please make a point of hitting that thumbs up, hit that subscribe button. And so looking at their initiatives, one key item that they talked about was fulfillment, where they're talking about splitting it from a national center to various different regional fulfillment centers, and talking about how this has resulted in much better fulfillment rates, delivery times, and how that actually directly leads to more business. When people can confidently get their items in a timely, very quick way, they go, oh, I'm more likely to make this a habit. You know, if you're going to pick up some beauty product, you're going to say, hey, you know what, I just need it today or tomorrow. Let's just pick it up right now because I'm used to using Amazon. I'm used to getting fair prices. You know, they talk about one of their initiatives in Texas, College Station, how now you can receive prescription medication at home within an hour at no additional cost using their drone delivery service. So that's very exciting to see. Lots of investments in fulfillment. They also talk about how they think they can make a big bet in terms of the medical field with pharmacy, the new first of its kind partnership with Blue Shield of California to offer Blue Shield's 4.8 million members fast and free delivery of prescriptions 24/7 starting in 2025 using Amazon Pharmacy. So this is clearly a big bet, big focus. Not surprising. Amazon has expressed previously, you know, how it's just an absolutely huge market, ripe for disruption, ripe for innovation. So I am excited to see what they can do there to lower costs in the system. We'll see what they can pull off. Clearly, there's a lot of potential. They also talk about how they think the Amazon Prime videos, you know, could actually be a significant profit center for them in the future. I'm a little cautious on this because you look at the best in breed global company, Netflix. Netflix only has a sub $200 billion market cap versus Amazon, you know, $1.3, $1.4 trillion market cap. And so even if Amazon Prime Video became a standalone product that, you know, you could say, hey, could someday be worth what Netflix is now, you'd still have something that doesn't even move the needle that significantly for Amazon, because once again, $1.3, $1.4 trillion company, you know, versus Netflix, sub 200 billion. So it could have a favorable impact. Don't get me wrong, but this does reflect how Amazon is such a big company. You know, $1.4 trillion, $1.3 trillion, that's a lot. So you have to have a lot of big moonshot bets in order to really say, hey, this is how we're going to go from $1 trillion to $5 trillion over time. So you need to believe they're not only going to hit it with Amazon Prime Videos, but they're going to hit it with healthcare. They're going to hit it with drone deliveries. They're going to hit it with AI. They have to hit it, you know, one win after another in order to get really attractive growth, in my opinion, from here. in terms of a share price to get the historical type of returns. Another key initiative, Amazon is leveraging AI, particularly generative AI, across its sectors to enhance customer experiences, optimize operations, and support third-party sellers with notable applications in advertising, voice interaction via Alexa, and AI solutions in AWS for their broader accessibility to developers. So there's a lot of investments going on here in the AI space. That said, despite a lot of favorable developments, I'm generally more cautious here with Amazon, and I'll talk about it in just a second why. First of all, in full disclosure, this is not financial advice. Where does Amazon stock go from here? First, a quick plug. At Unrivaled Investing, my goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com. If you'd like to learn more, I'm going to talk about one of the companies I covered this past week shortly. So thinking about Amazon, where does it go from here? I check in with AI Ticker Chat, which leverages artificial intelligence, scans the latest transcript, latest earnings to get a feel for where can this company go, gives a ballpark feel for the revenue growth potential over the next 5 years, the margin potential over the next few years, the earnings multiple 5 years out. It's saying it's close to 200% upside. I'm a little bit more cautious on this. I think this upside framework with AI Ticker Chat, and once again, its first month is free, covers almost all US companies above $300 million market cap. I'm looking at this and, it's assuming a significant growth reacceleration. It assumes margins, nearly double from their prior COVID peak. So you're seeing significant margin expansion, and you're seeing a very lofty multiple, several years out, 35 times multiple. So personally, I think it's more likely to look at the base and bear type of scenario where maybe you're up 40%, maybe you're down 30% over the next few years versus, this type of upside scenario. It requires an acceleration in growth and expansion in margins that I'm not quite sure I'm aligned with. But look, let's take it one quarter at a time. When I do my own detailed individual analysis, looking at it on a per segment basis, looking at North American ops, international ops, AWS, looking at these different pieces, it's a little bit of a tighter range, looking at a smaller loss on the downside and maybe closer to 100% on the upside, not even giving full 100% upside. And this is why I'm cautious. I look at this and I think there are honestly better, risk rewards out there. That's how I personally look at it. And let me give you an example of sort of the detail behind Amazon in terms of these figures, what gets you there. So North America, one of their key operations, one of the key contributors to this valuation. So growing at around a teens level this year, I'm assuming, hey, let's provide a range where margins either stay flat or they effectively double over the next few years. And then assuming around 20 times multiple few years out, 5 years out, and that they continue to grow at around the same clip, around 8 to 12%. Well, in this hypothetical framework, of course, stock price can go way higher, way lower. This contributes around 25% of the existing market cap to maybe 78% of the market cap. So then the rest of the value has to come from AWS or international. With international still not really proving their profit margins, maybe you can assume, it gets to 3, 4, 5% profit margins. The growth isn't as impressive. The profit margins aren't as impressive. It's really AWS. And assuming, hey, how big, how compelling can that be? So my reservations are a few. First of all, Amazon, it's an amazing company. It's clearly unrivaled in terms of getting, goods and services to consumers, and they continue to make these incredible bets that will help consumers out, help merchants out too, like their shop with Prime for the Shopify merchants. So there's a lot going on that's favorable. That said, if you do have any sort of economic impact, and we haven't seen a recession yet, you're starting to see signs, warning signs that it could be happening very shortly. That will impact the consumer, and that will impact Amazon. And the truth is, at this point, Amazon, it's largely AWS and North American consumer, I'd say, when you're looking at valuing this at this point. And so if the North American consumer takes a hit, that should result in slower growth, lower profitability. And then, investors are going to say, I'm just not quite sure it's there. And I think even though these results are solid, I don't think it's enough to push Amazon into the, hey, we're going to be making new highs type of territory anytime soon. So I think you're going to be range bound for potentially years to come. And that's part of the challenge. Another challenge is you're looking at, the government, putting their finger in the pie saying, hey, you're not doing this right. I did a whole separate other video saying, look, I think this is just a complete misstep by the US government suing, Amazon, but still it's a distraction for management. I mean, there's a reason why Jeff Bezos was like, hey, peace out. I don't want to deal with these knuckleheads. I'd rather be on my yacht with my wife. So I look at that and I go, okay, the founder who turbocharged the growth for Amazon, he's piecing out because he recognizes the noise. You have consumer that's arguably going to start getting pinched at some point. I think recession's more likely than not, in which case, Amazon's growth decelerates. You see margins, face a potential pinch. And by the way, Amazon's a $1.3, $1.4 trillion company generating around $20 billion in free cash flow. That by no means is like deep value compelling free cash flow multiple. Like what I would want to see for that type of setup is something where it's like, oh, it's generating $80, $100 billion in annual free cash flow. And by the way, they can retire a few percentage of the stock in, the shares outstanding. That's personally what I would want to see. So I do think there are better plays out there. And that's ultimately what this comes down to is, I look at this framework and I say over the next few years, using a conservative framework, it's down. Using a much more aggressive framework, it doubles. That I would rather pencil out, and I call out to my subscribers situations where, hey, I'm going to put capital to work. Maybe it's flat over the next 5 years, but over the next 5 years, there's also the possibility it goes up by 5x plus. So that's personally what I'm looking for, or at least situations where on the conservative side, I can more easily underwrite, let's say 50 to 100% upside. For example, this week, what I called out to my subscribers at Unrivaled Investing, I did an exclusive video. I called out Pershing Square Holdings, which trades at nearly 40% discount to liquidation value. So that's run by Bill Ackman. And so it's very possible. I don't own Pershing Square, but I sort of walk through the figures, walk through the potential and show it's very clear that if there's just a very conservative return over the next few years and the valuation gap closes, you could, very potentially see a 50% return in a very conservative scenario. So once again, I call that out at unrivaledinvesting.com. And so I look at this and I look at Amazon, I look at the rally it's had so far this year. Clearly part of it's justified. Going from a $20 billion cash burn to $20 billion in free cash flow, that gets a lot of investors excited. But to go from here, you're going to need to see it go from 20 billion in annual free cash flow to 50, 100 billion in free cash flow. And that's a lot harder. And that's going to be what would need to drive the stock from, let's say, 1.3 trillion to, 2.6 trillion. And I just don't see that happening really in the next year or two, in which case, that's part of the reason why I'm cautious on Amazon. I like their growth initiatives. I like what they're focusing on. I just think there are better plays out there. If you disagree, I'd love to hear the comments. Love to hear your comments below. Thanks so much for watching Unrivaled Investing.